What's happening on the other side of the world is horrific, and the humanitarian and economic impact is going to be tremendous and possibly long-lasting. But what does that mean locally for our housing markets and our economy? That's what Dr. Andrew Wilson and I are going to discuss in this week's Property Insider video. If you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so we can keep you updated every time a new show comes out. Only yesterday I was shocked to read the headline, "Property prices are set to tumble 15% as the Ukraine crisis bites." And it seems like the media and many commentators are looking for an excuse, any excuse, to explain why our property markets are going to crash. A couple of years ago was the fiscal cliffs we were going to fall off, and then it was massive unemployment, and more recently surging inflation and interest rates that would cause our property markets to implode. And this is despite history showing us otherwise. But now AMP have come out suggesting the fallout from the Russian invasion of Ukraine could slow residential property sales. It would increase inflationary pressures and would accelerate downward property prices of about 15%. And that's despite Australia's property markets generally performing well during major economic, military and terrorist crises over the last 40-50 years that I've been tracking the housing markets. And these forecasts don't seem to take into consideration the strength of Australia's economy at the moment, the fact that we've got a shortage of good houses, which is only going to be challenged by a flood of incoming migrants, and they're not taking into account the resilience of our housing markets and Australia's banking system. Now, what's happening on the other side of the world, it's horrific, and the humanitarian and economic impacts are going to be tremendous and probably long-lasting. But what will it mean for our property markets locally? That's what I'm going to ask Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market, in this week's Property Insider Chat. Hi, Andrew.
Yes, good morning, Michael. It seems we're forever discussing outrageous house price forecasts. No, it's another week goes by and it's another outrageous forecast regarding house prices. And it does come from the usual suspects, of course. It doesn't seem to bother them too much when they're proven wrong. And I guess that's all about short-term memories in media land. And but look, at the end of the day, it's a bit of fun, I suppose, to review these silly forecasts. But from the point of view of consumers, really, you wouldn't want to be making financial decisions based on the roller coaster ride of house price forecasts that we typically have. It's a bit of fun to look at these numbers as they change, and there is a short memory span in the media for the erroneous outcomes mainly that occur. But it's not the environment that you want to be using as a base for significant financial decisions. And I think that's the difference that we try to make, Michael, is that we're about rational insights that you can look to generate your insights into your financial plans. And isn't that what we all should be about? Not just trying to chase cheap headlines.
Well, Andrew, in the same article in the Financial Review, they reminded us that property prices in Sydney's harbourside postcodes plunged 36% when the mini submarines launched their attack in the Sydney harbour in 1942 at the height of the World War II. Really?
Who's the journalist, Michael?
History shows that major international crises tend to cause short-term falls of confidence, but they promptly rebound once the political tensions ease or an economic growth resumed. Now, I don't know, in my mind, the biggest threat of the Ukrainian crisis is escalating into a regional war, a nuclear war, and hopefully that's not going to happen. But what's, I guess, more likely to happen is maybe rising oil prices, rising energy prices, increasing inflation a little bit. And sure, it may slow our economic growth a little bit, but Andrew, why would it cause our property markets to fall?
Well, we could speculate on what could happen to the nth degree as a result of what's happening currently, and let's hope we don't get those extreme outcomes, Michael. I think that's getting a little bit ahead of the game at the moment, but certainly the issues you mentioned there, the economic outcomes are what would affect our economy, and that would be a higher fuel cost, which would work its way into inflation. And of course, that has downstream consequences. But we have to have incomes rising for the Reserve Bank to be thinking about as well, to the Reserve Bank to be thinking about higher interest rates. So it's a conundrum for us, but what would you be doing? Just selling your property? It's always an exciting opportunity for those that like to chase cheap headlines when something such as the European war occurs. And there's always hopefully, of course, that this will settle down, and that's the get out of jail card when it doesn't move into an extreme outcome. They can say, oh, well, that would have happened if that had have occurred. But to be quite honest, Michael, if we were heading towards a nuclear war, I think house prices would be our last of our concerns.
You're right. Now, we've spoken in the past that overall Australian house prices over a year, based on the Australian Bureau of Statistics, have never fallen more than around 5.5%. But what's the worst case that's happened in an individual market, Andrew?
Well, we looked, Michael, we analysed the capital city markets, not just the national markets, in terms of calendar year falls. So that's the fall from December quarter to December quarter using the ABS data series, which goes back to 1987. And we can see again that the worst results are Melbourne and Sydney at around about 7% annual falls. So those that are predicting double figure price falls over a year are certainly not looking at the historical evidence because that would clearly be unprecedented in terms of the modern era in house price growth. I'm not sure what sort of a methodological approach that these analysts, these economists are using. What sort of time series factors are they gauging? Perhaps we should ask them what their methodology is, Michael. Rather, unfortunately, it might be just sort of throwing the dart at the dartboard or picking a number out of a hat, but it doesn't seem to be rational in terms of the historical evidence, which is where you should really begin, I think, in any methodological approach for time series forecasting. And as I just said, that the worst declines over a year in house prices on a capital city basis were Melbourne and Sydney, around about 7 to 8% over a year, and that's well short of the 10 to 20% that's currently predicting. And Michael, just adding to that, even if we look at the non-calendar year annual falls, in other words, not December to December, but if we look at annual falls in other quarters, the highest result there is around about 10% on any quarter to quarter fall over 12. And that was, of course, during periods of not just cyclical issues, but also seasonal issues as well. But even then, it's well short of what the forecasts are now generally for Australian house prices. But even if the get out of jail card for those predicting the extreme outcomes for house prices is saying the peak to trough falls in terms of the cycle are concerned, but the sharpest peak to trough fall that we've had in house prices, according to the ABS, was around 13.7%, Michael, in house price falls in Sydney. And that was between June 2017 and June 2019. So that's a 2-year period where house prices fell by 13.7%.
There are other factors involved in that as well, and basically a credit squeeze, the sort that we hadn't seen for a long time.
We had the fear factor also, which created momentum during that period, and that was when APRA were acting to tighten lending.
Definitely. And at the moment, though, our economy is doing really well. We've had the strongest lift in the economy since 1976. So the recession some of these commentators were predicting because of COVID and because of the lockdowns, that didn't come to fruition either, did it?
No, it was a busy week last week for data, Michael. Of course, on the Tuesday, we had the Reserve Bank again confirming that it's certainly still got a wait and see approach to higher interest rates, and it's prepared to be patient. Just reiterating what it's been saying for months. We also had the home loan data out, which was another record month over January for home lending, but the rate of home lending is starting to decline, even though it is still at a record level. But the big data there was that investors are continuing to surge, really a lot of activity from investors over January. First home buyers are falling, no surprise, with higher house prices, and they are now below their long-term market share. But really, first home buyer activity is held up pretty well. And I think that's a little bit of the bank of mum and dad acting to support first home buyers in that, I guess, sense that property remains and is increasing as a safe haven for investment. And of course, as you mentioned, we had GDP for the December quarter, strong result. No surprise, it was a bounce back from New South Wales and Victoria and Canberra following lockdowns in the middle of last year. But from the point of view of interest rates, Michael, there were some commentators who were saying that the Reserve Bank may be looking at the wage implications that come out of the GDP. There was nothing there to get excited about. In fact, if anything, it was on the downside. We certainly had a pickup in compensation to employees, which was no surprise given that compensation to employees had fallen over the September quarter. It picked up over the December quarter as a bounce back, but there was nothing really exciting about the 2.2% increase over the quarter. But on the other hand, we actually had a fall in disposable income, which is concerning, over the December quarter. And we actually had a sharp fall in the savings ratio as well. Still pretty high, the savings ratio, Michael, but it does show that consumers are starting to work their way into their savings because perhaps of higher prices and that lower disposable income. These are certainly not the circumstances that the Reserve Bank would be considering to raise rates, because it does not support in any way the rising of wages. And it certainly follows the wage index data that we had released a couple of weeks ago in regard to that December quarter. So good news, not really a surprise that we bounced back. Australia's economy is doing very well, but we are certainly not seeing the wages increase that would be needed to substantiate an increase in interest rates anytime soon. And that's what the Reserve Bank has been telling us for quite some time, Michael.
Other data coming out last week also was the building approvals,
Yes,
which were released by the Australian Bureau of Statistics, and they showed dwelling approvals for new homes fell back to pre-pandemic levels. Of course, Andrew, one of the questions one really has to ask is, how much was housing construction brought forward due to home building and other state-based construction grants? And this is just the spin-off from that.
Yeah, absolutely, Michael. And there was a sharp fall, and we are moving back to more of that pre-COVID normalisation. And Australia's been underbuilding now since 2015. Our supply lines have fallen dramatically. And this is why we're seeing rents go through the roof as one instance, not just the credit squeeze that took investors out of the market, but we're just not building enough houses. And this is only going to exacerbate housing shortages when our mass migration starts up again, which is imminent. And I know that the industry said, oh, well, it was just a response to the issues with COVID during January. But look, that really doesn't hold water, that argument overall, because there were markets such as Perth where we saw also home approvals falling. And of course, they didn't have the same issues in regard to COVID that particularly Melbourne and Sydney did through January. So it is, you're right, absolutely, just the moving back through that stimulus period for housing. A lot of demand has been brought forward. And we've also seen that in the latest data on house building costs, which are continuing to rise quite strongly. And of course, it'll take some time for building costs to flatten out. And mainly that's reflecting increases in the cost of materials and supplies rather than labour. The rate of increase has declined for building costs over the January quarter, but it's still high. And the annual increase for building costs for houses, Michael, is a record. It's up nearly 18% over the year to January. So my point is that this will work its way into inflation as well.
Unfortunately, some builders are going to suffer from this. Those who've entered into fixed price contracts, we've seen it on a much larger scale with ProBuild, but hopefully there won't be too many small builders who are going to go under not being able to complete their contracts based on rising costs. I know some are trying to renegotiate their already set construction contracts.
Yeah, that's right, Michael. And it's the old story. When we have too much demand and not enough supply in the shorter term, it can cause these imbalances. And in the type of industries that, well, the building industry is, the house building industry is, that can cause stress amongst builders that are, because of high levels of competition and low market power for individual builders, can unfortunately lead to some very serious financial issues.
Well, we started the autumn season. We're in autumn already, Andrew. The autumn auction season over the weekend, it officially began. What's your take on what's happening around Australia in the auction markets?
Well, it was the official opening of the autumn selling season, Michael, but really the autumn selling season starts in February. But it was, I guess, in terms of it being March, the first day of the autumn selling season, the weekend markets. And I thought we had some good results again. Markets are still standing up, Michael. We're getting mixed results in terms of prices in some of the markets, but certainly the auction markets are still very much favour sellers. Sydney had another big day of auctions. Auction numbers are falling away now from those record February levels, but they're certainly very high still in Sydney. And Sydney clearance rates are still quite high. And those sales numbers for the early season market are still around record levels, and Sydney's auction prices are continuing to rise. So still quite a seller's market in Sydney, despite high numbers of listings. Melbourne market similarly is producing high numbers of listings. This would have been our Super Saturday in Melbourne, typically the weekend before the Labor Day public holiday is a Super Saturday. But of course, we're a week later with Labor Day holiday this year compared to last year, Michael. So we haven't had the same Super Saturday effect in Melbourne at the weekend. Still high numbers of auctions, but not the Super Saturday we typically get because we're a week further into the season and we've had record numbers of auctions in Melbourne over February. But nonetheless, another strong clearance rate in Melbourne. It was higher than the weekend before from higher listing numbers. So the Melbourne market is still standing up despite significant activity over the and high levels of prices growth impacting affordability over the first part of or the first months of this year's season. Interesting, no surprise, the Brisbane market listings and clearance rates were down. There are obviously issues there with the floods that sidetracked a lot of buyers and sellers up there, and that'll pull back. But numbers were still quite high in Brisbane. These are extraordinary numbers for this time of year. Similarly, Adelaide produced another good result from, again, record level numbers of auctions, and Canberra has been falling a little bit over recent weekends. Again, similar to Adelaide and Brisbane with record numbers of auctions and still quite a healthy clearance rate in favour of sellers, but certainly that market is struggling under what has been extraordinary prices growth last year and affordability and the satisfaction of pent-up demand acting to ease the market. But really, all in all, Michael, these markets are still very healthy in terms of the seller's perspective and maybe even from terms of the buyer's perspective, because they can secure property without having to pay those extraordinary premiums that they did last year under the hammer.
Yes, it really seems like the weather events, the wars and all the other concerns haven't stopped our property markets, and we sort of knew that was going to happen anyway. So I look forward to catching up with you again next week as we unpack what's happening in our property market.
Yes, thanks a lot, Michael.